Hey guys, welcome to howtoplaystock.com. My name is Kepley. Today is January 5th, 2017, and in today's video I wanted to cover the topic of value investing. And what is value investing really? Well, you might have heard guys like Warren Buffett talk about it. He's really big on value investing, and basically what you're doing is it's a strategy for growth when it comes to building wealth. And part of that is finding value in stocks or companies, and then riding up, basically getting in low and then riding the growth up as it builds value. Okay, so that's what today's video is about, and stay tuned and keep watching, and in the next portion of this we'll break that down for you, all right? Alright, so we're covering value investing, and I want to emphasize on how you go about doing that, and that is with leverage. Alright, now what is leverage? Leverage is basically a way for you to get your money working for you in your sleep, okay? A good example would be compounding. Alright, now to give you an example of how this works, the best way to take advantage of value investing is to not speculate. Okay, you may have heard guys like Warren Buffett talk about, the fact that he likes to stay away from speculation. He'll only focus on things that are in his circle of interest. Okay, and there's a lot of truth to that because I've actually applied that to my own investing strategies. Value investing is when you can find value in a stock, and the easiest way to do that without really, timing the markets, without doing a whole lot of research. This is just a way to do it and save you time and having to go in and look at balance sheets, on a consistent basis, and income statements and all that, because that takes up a lot of your time, and I know that a lot of us don't have that time to go ahead and do that kind of stuff. So an easy way to do this, when you're first looking at a company, and this would go for basically growth. All right, so this would be considered a little bit higher risk when you're investing in a single company. So I want you to know that before we really get in depth here with the value investing and compounding. But when you first invest in a company, you do want to look at things like the financial statement, the income sheets, stuff that would give you indicators that there's value there. You want to look at that stuff, but after you've made your investment, an important thing that I like to do anyways is look for stocks that pay out dividends or a paycheck. And the monthly ones I like better than any of the others. There's other stocks out there that'll pay out dividends every 3 months. Some that only do it once a year. But I like the ones that pay once a month. And the reason why is because, I'll give you an example real quick. Let's say you bought in on stock WSR. Okay, now this is a real estate stock. It's a REIT, and right now its price is at about $14. I want to say 17 cents, roughly around there. All right. Now let's say you make an initial investment at $14.17, right? And it could be a couple $1,000s, could be $10,000, whatever you might have. Let's say you make an investment in that, and you're trying to take advantage of value. You want to get some value out of this stock and earn some profits over time with it. All right. Now, what you do basically, this one pays out a monthly dividend on it, so it's at roughly around 9 cents a share. So I'll just throw that in here real quick. 9 cents per share. So what you want to do is, throughout a period of time, we'll just lay out a bottom chart here, and we'll just say this is in 1 year. Alright. Just drawing out a little chart. But let's say we bought in here at $14. This is where we made our first investment right here, where I'm putting this little red dot. Now, what happens over time is this stock will go up or down in value. Okay? So for this example, we'll just say it goes up. So it's going up in price, right? And down here, this is a 1 year time frame. So let's say you bought in, around April, okay? And the stock goes up, and by May time frame, we're right up here, and it's jumped to $16. And each one of these little slashes here just represents $1, okay? That's 15, 17, 18, and so on. So now we're at $16 a share. Well, you would have made a $2 profit on each share, or roughly around that. So you would make some good returns. However, when this thing is paying out dividends, instead of withdrawing the dividend for a paycheck, what you would do is reinvest it so that it compounds for you. And whatever that paycheck was, let's say it was like $30 or $40, okay? That $30 or $40 would then jump in and buy up stocks on this stock here. It'd buy up more shares for you, but it would buy them at $16 a share. So now it's costing you more money to buy that stock. Now that's not necessarily something that is going to give you value, okay? But here's the catch. Even though you're buying at a higher price, and there might not be as much increase in value, like from that money that the dividend is buying for you. So the money that was supposed to be paid out to you, it's buying up more shares, but it's buying them at a higher price. So you may not have gotten any value increase out of that because it's costing you more, but you did get some value out of the stock and the shares that you own, like when you first made your investment. So you're going to get some value out of that because you got a $2 increase. All right, so even though you're paying at a higher price, you still have gotten some value from your initial investment. Now, let's say the price drops from $16 and it goes back down over the next 3 or 4 months. And this time it hits right around $13. Okay? So now you're buying shares at $13. You're buying in at a lesser price than what you made your initial investment. Now your dividend that was being paid out to you, it's reinvested through compounding. Now you're buying up shares at a lower price, which means you're buying more shares with the money. So in other words, when you first got your paycheck and you got your $2 increase in the share price, let's say the paycheck was $40, and $40 bought you a couple shares there. Now it's dropped down to 13, so you're losing value on your stock from your initial investment, but you're making up for it now because your $40 paycheck that's paid out to you each month is buying you up more stock at a lower price. Okay, so you're still getting value because you're buying in lower. The thing is, how do you make returns when you invest? Well, you have to buy low. You have to buy at a low price, and then when it jumps in value, you're getting a value increase on the stock. Okay, so it's a way for you basically, with compounding, it's a way for you to take advantage of leverage, even though you might be buying in at a higher price with the dividend. Chances are, a few months later, you're going to be buying in at a lower price. And you're going to be able to make money on the front end and on the back end, regardless if the price goes up and down. Okay? And that's based off of some of the examples that I just showed you here with a dividend that's attached to your share when it's paying out, say, like a monthly paycheck. All right? That's the easiest way to go about value investing and creating value from your investment without having to do a whole lot of research on it. Again, you'll do the initial research up front when you invest in the stock, but after that, rule of thumb is when you make an investment, and this is coming from Warren Buffett, rule of thumb is you want to make an investment and hold on to that stock for at least 10 years, okay? Treat it like you would if you bought a house, okay? So if the value of your house were to drop, 2 months from now after you just bought it, you're not going to turn around and sell the house. You're going to hold on to it because the value might go up and down, but over time, you're going to build value from it, all right? Now, a house is a little bit different than a stock, but there is equity there. And I'm just comparing the house to a stock because, when you're looking at holding on to a stock, that's kind of how you want to, that's the concept you want to keep in mind, when you're taking your approach to holding on to that. Because over time, with this compounding, you're gonna be able to build a lot of value over it. Okay, and take it from me because I've done this with several stocks already, and I was profitable on them when I ended up selling them. I just didn't hold on to them for too long, but the dividends did help. And the other thing is, with compounding, guys, Einstein said this back when he was doing all his research and when he was still alive. Einstein said that compounding is what he considered the eighth wonder of the world. It is so powerful when it comes to building wealth, and it's like the snowball effect. So those dividends come in and buy up share prices for more shares of a stock for you, regardless if it's a high or a low price. It's gonna continue building wealth for you, and it's you don't have to work for it. It's something that's there automatically for you each month. All right, now those dividends can be cut, so compounding, you can take advantage of it and gain some leverage, but that leverage can go away, so you need to watch out for that. But if you're invested in the right stuff, chances are, that the odds of that happening are going to be reduced significantly for you. And if you're curious about, what you would invest in to reduce those odds, go ahead and subscribe to my channel because I've got a lot of stuff and a lot of information that I've obtained over the years with my investing career that'll go ahead and show you, more about, what financial tools actually will help you do that and reducing your odds of getting, say, a dividend cut or, just losing money overall. So that's all I have for today's video. Again, subscribe to the channel, and here soon I'm going to be releasing a e-course, a beginner's guide to investing e-course that covers basically everything that I know and have experienced over the last 8 years of investing. It's going to have like 10,000 hours worth of research that I've done, $7,000 worth of my mistakes, and a lot more when it comes to knowing how the 1% of the wealthy invest their money. Okay, so that's what I've got coming. I'm probably going to launch that here, I'm hoping, in the next month. I'll let you guys know. But that's all I have for today. These are today's investors' investing tips. You're tuning in to howtoplaystock.com. And remember, guys, income is the outcome, all right? I'll talk to you later.